Carl Icahn, one of Wall Street's most well-known billionaire investors, has spent years preparing his portfolio for a major stock market crash. The issue? He's been holding this position since 2017, and over the past 7 years, while the stock market has continued to rise, he's lost a staggering $9 billion. That's an enormous amount of money, even for someone like Icahn. In a recent interview with the Financial Times, he admitted, "I've always told people there is nobody who can really pick the market on a short or intermediate term basis. And maybe I made the mistake of not adhering to my own advice in recent years." It's easy to see why he made that bet. When the news and social media are constantly filled with warnings about an impending market crash, it's tempting to think that the stock market has to drop soon. Many investors wonder, why not just wait for the fall and then jump in when prices are lower? It seems like a smart strategy, and honestly, it's not a terrible assumption. The market very well may dip at some point. But here's the thing. Betting on that crash is not as wise as it seems. Let me show you some data that reveals why trying to time the market is usually a losing game, and why there's a much better approach to managing your money right now. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Peter Lynch is widely regarded as one of the best investors in history. As the manager of Fidelity's renowned Magellan Fund, he delivered an incredible 29% annualized return over 13 years. He's also written several books that have become must-reads for both new and seasoned investors. One of his most powerful quotes is, "Far more money has been lost by investors trying to anticipate stock market corrections than has been lost in all the corrections combined." Lynch is right. Trying to time the market by jumping in and out of stocks or holding cash in anticipation of a correction is one of the biggest mistakes you can make. You've probably heard that market timing doesn't work, and Carl Icahn has preached the same thing. Yet, despite this advice, Icahn still tried to time the market himself. Why? Because, like most investing mistakes, it's driven by emotions, greed and fear overpowering logic. I'm here to help cut through the noise of sensationalized headlines and show you the data that proves just how ineffective market timing really is. The data I'm about to share comes from Nick Maggiulli's excellent blog called Dollars and Data, which I highly recommend you check out. Market timing is based on the idea that if the stock market is likely to drop, it's smarter to hold cash now and invest only when the market has fallen. And yes, it's true that the market is likely to drop below its current levels. In fact, between 1970 and 2019, if you picked any random day from the US Dow Jones Index, there was a 95% chance the market would eventually fall lower at some point in the future. This means that, on average, only 1 out of every 20 trading days saw the market move higher and never return to that level again. To visualize this, picture this graph. The black line represents the Dow Jones Index's performance over the last 50 years, while the red line moves up every time the market hits a new all-time high, creating a low watermark, a price point the market never drops below again in the future. These watermarks are the best possible times to have invested. Let's take a look at an example. From 1990 to 1997, the market hit several all-time highs, and in hindsight, we can see that these prices never dropped again. This was a tough time for anyone trying to time the market, as they would have been sitting on the sidelines while the market surged higher, never returning to those levels. Fast forward to April 15, 1997, when the market hit a new high of 6,457. Over the years that followed, the market continued to set new records. But then, on March 9, 2009, during the Great Financial Crisis, the index fell back to this level, meaning that for the next 12 years, waiting for a market dip to invest would have worked. However, this hindsight is pretty pointless because, to make that move correctly, you would have needed perfect foresight about the market's future, a nearly impossible feat. But what if you actually could predict the market's moves and time everything perfectly? how much better would you be doing? Well, that's exactly what Nick Maggiulli tested. He started with a basic strategy of dollar-cost averaging, investing $1 every day for 49 years, regardless of what the market was doing. By the end of that period, this strategy would have turned $12,623 into $168,000. Not bad, right? But Nick then tested a second strategy, assuming we had the foresight to time the market perfectly. Instead of investing every day, this strategy saved the dollar each day and only invested it when we knew it was the absolute best price. So, between 1997 and 2009, instead of buying daily, this strategy waited until March 9th, 2009, when the market bottomed. After 50 years of perfectly timed investing, how much better off would you be than with the first strategy? Just 22% better, or an extra 0.4% per year. That's it. Even with perfect timing, the difference isn't as big as you might think. This shows how little market timing really matters. Now, think about how much time and stress you'd have to endure to execute this strategy in real life, where you don't know what's going to happen next. And let's be honest, if you're tempted to time the market, it's probably out of greed or fear, which means you likely don't have the emotional discipline to stick to this kind of strategy. In reality, you'll likely end up like Carl Icahn, sitting on the sidelines, watching the market rise higher and higher, until eventually you give in and buy at a higher price. As Peter Lynch wisely said, it's a mistake to sit on your cash and wait for a stock market correction. In trying to time the market to sidestep the bears, people often miss out on their chance to run with the bulls. So, what's the big takeaway here? Sure, we'll see stock market crashes in the future, and yes, it's likely that prices will drop below where they are today. But guess what? In the grand scheme of things, it doesn't really matter. The constant stress of trying to predict the market's next move is a losing game. Instead, set up an automatic investment plan and let your money grow, no matter what's happening on Wall Street. Put your energy into things you actually control, like learning new skills or boosting your income. The market will keep doing its thing. Focus on what you can do to improve your own future.